Hello, welcome back to Your Money in Real Estate. I've got the illustrious Ken Craig with me. Ken, before the break, we were talking about, different ways of alternative investments or, how can someone really get started, where can they go kind of thing, whether one fund's better than not. But let's pick up from where we left off.
Sure. The thing is you're going to start hearing more about alternative investments. The viewers out there, it's going to become a reality of what needs to be part of our portfolios. And we're going to get into some slides in a few minutes that are really going to talk about that. But what I want to stress for the viewers out there, again, is that you've got to spend the time doing your due diligence just like you would with any other advisory group. You want to find a home that makes sense for you, where your goals, that people are spending time ensuring that they know what your goals are, what you want to get out of this. Why are you investing in the first place? What are you looking to gain from it?
A lot of these questions, though, it's the exact same that I know a lot of viewers, talk about is, buying a rental property. I tell them, write out a business plan. What is it that you want? What are your goals? Why do you want, do that? And part of it, of course, is exactly the word is due diligence. Mm-hmm. So it sounds like whether you're investing in an alternative investment or a rental property, if I can use that word, is due diligence.
That's right. Do your due diligence, do your homework, get on Google, put some names and do what you got to do.
Yeah.
Do your due diligence on these organizations, and it's a great way to say it. Because the reason I'm stressing this is because alternative investments are great, but not all alternative investments are right for you.
Got it.
And depending on where you are in your life, what you're trying to achieve, there's things that you got to be careful about. And again, alternative investments, it's just investing in, let's say, real estate. It's third-party real estate. It's not complicated again. It's just that I think a lot of us have been able to find better returns and greater diversification with these. Yeah.
You're talking about something that I know I'm interested in. I know a lot of viewers out there are interested, is the return. Again, I'll refer to a rental property versus alternative,
sure,
if you don't mind. So I know that on a rental property, people can say, oh my gosh, I buy a rental property, if I include appreciation, mortgage pay down, I can make 20-25%.
Sure.
Yeah, I'm going to have to fix a toilet every now and then. Give us a ballpark on the kind of returns that some of your investments or when you say higher returns, what does that mean?
Listen, we got to be careful when we talk about
I don't mean to put you on the spot.
Yeah, and all products are different. What we target and what we shoot for is we're generally looking at products that are going to range in that 8 to 12% range on an annualized basis.
Okay.
Does past results necessarily equal future results? No. But when we look at projects, when we look at taking something onto the shelf, when we look at bringing something to our client, our target is in that range, is in that 8 to 12% range.
And Ken, you don't need to apologize about, being careful, because in rental properties, it's the exact same thing. You look at a property, say, this is the perfect property for me. It's a duplex, I can manage it, bing, bang, boom. You get in there, you get one wrong tenant, you're in tribunal, you're losing money, and all of a sudden, all your cash flow, everything you predicted goes out the window.
That's right.
So the idea when you analyze a rental property and you analyze an alternative, both of them carry the same risks. They carry the same future projections. So to say, well, I think you're being probably very accurate that 8 to 12 is probably a safe window to go with, even on a rental property.
Sure. And so the projects we're looking at that. And again, what I encourage you to do is we help. That's why we're out here. My mission when I started AltaView Financial Group, and the reason I'm saying this is to really help level the playing field for the average client. And I'm going to go maybe on a tack here for a second, if that's okay.
Tacked away.
All right. Is that, there's opportunities that have been out there for wealthy investors that have always been there.
Right.
And I've got this rule, and you can apply it just about anywhere in business. And the greater the barrier to entry, generally the greater the profit margin that exists there. And the reality is that there's been so few players when we look at development. There's been so few players when we look at hotel chains. There's been so few players when we look at large lending on institutional dollars.
Yeah.
That they've been able to make good money doing this.
Sure.
They always have. And so the question goes, well, why are we not doing it?
Yeah.
Why am I not doing what they're doing?
Why can't the little guy get involved with this? How does a little guy get involved?
Well, before he couldn't.
Yeah.
He couldn't. The reality was that if you wanted to go do a development, well, guess what? It's $80 million to go do the development. You might need $20 million of your own money. And most of us just don't have that. I mean, the reality is...
Yeah, and who do you talk to about this kind of stuff? What, you go knock on some developer's door and say, here, I got $25,000 in RSP. You want it?
Yeah, you can't.
Yeah, exactly.
Right, so there's a couple of barriers to entry. One, we just didn't have enough money to do it. Two is we just didn't know.
Right.
A lot of you here today are listening and hearing for the first time what alternative investments are all about, that they even exist, and that it should be something part of your portfolio. So we just didn't know. And the other problem is you can't get it through your traditional channels. A lot of time when you sit down with your financial advisor, he's working with some limited tools, right? Not saying that you shouldn't have those in your portfolio. Stocks, bonds, and mutual funds make up a diversified portfolio. But he may not be able to offer these alternative products. And so you've got to go out there and hunt for these and find them. There's been some reasons we just haven't done it. What we help our clients do is really get the ability to get involved in areas that they wouldn't be able to previously. And how we do that is this concept called syndication. Okay. We just group investors together, and while one investor might not have the $20 million that's needed to go and build this development or the $6 million it is to build this hospital, but if we group the investors together, well, guess what?
Yeah.
20,000 here, and the numbers add up. Eventually we have enough that the investors can take part in an area that has that great barrier to entry, so more profitability in it, and actually start taking advantage of these profits that have always been there.
Now, when you mentioned that, like some people would say, well, you're a financial planner. I know that a lot of them don't have a financial planner. Can someone just go out and go to a bank and say, here, I want to invest in alternative investment?
Yeah, unfortunately they can't. And that's where it gets tricky. You need to find the organizations out there. So if you're looking for some words to punch in and Google and try to get an idea, listen, it's going to be a bit biased coming from us. Obviously, I believe AltaView's got a great spot that can help you. But you can look up the Exempt Market is what it's called. It's called the Exempt Market. Exempt Market.
EMD.
Yeah, or EMD.
Yeah. Okay.
And some of them will come up, and you can go from there. Unfortunately, at the bank, it's not something they specialize in doing. They really specialize in stocks, bonds, mutual funds, in these types of vehicles.
And that lends me to the next question, which is a thing called security. Everyone looks at the big five banks, and let's face it, in the world stage, our banks are solid and they're sound. Is there the idea that, well, since banks don't carry it, well, therefore it must be high risk, therefore it can't be a good investment for us because the banks aren't carrying it?
Well, I don't even know if I want to. Well, I don't even know if I want to go into that specifically. But here's what I'm going to say: we've got to wake up, and this is where I start getting quite passionate about it. We've got to wake up because if we keep doing the same thing we've been doing for the last 10 years, expecting different results, well, there's a definition for that, right? And it's really truly insanity. But the problem is we don't know where else to go, right? If you're happy with the results you've received over the last 10 years with your bank, then keep doing it.
Fair enough.
But something tells me you're not. And most clients out there aren't. And the reality is, actually, we could bring up one of those slides maybe right now.
Sure. Yeah.
There's a slide there, that, the first one that we had would be great to take a look at.
And that'll probably explain a little bit about, or lead into what we're talking about.
Yeah. So I don't know if I can look up the screen here with you, but it shows the market's moving sideways here. And so this may reflect some of the results you've had over the last years. I mean, the reality is this. Listen, we've been saving for years. We're not getting the results we want. And it's not that your financial advisor doesn't like you.
Right.
It's not that he has a target on your back and says, I'm going to make sure that you have to work the rest of your life to get returns. It's nothing to do with that. Listen, they have your best interests at heart. They want to be able to help out. But if you look at the slide we have up there, it's showing that the market's been moving sideways. And it's not moving in a straight line. We've got a tremendous amount of volatility there as well.
Yep.
So you can see those ups and downs. And guess what happens? You see that big peak in 2008, and then you see it right at the top, and it starts dropping down again. And right where it drops at the bottom, we get so nervous. And what do? We sell it all, and then things start going good again, and we decide to buy again. And we're just doing ourselves a disservice.
So you're referring to though what we call the public market.
That's the public market.
Way back in the beginning, you mentioned private placement. So the alternative market is really a private. It's not publicly listed stuff.
That's right.
So that's when we looked at that chart there, it showed that's the trending of the public market. How does the alternative market trend? Is there stats that we can see how the private market trends, or is there any kind of documentation to show that?
Yeah, you can. And so there's a slide we have there, and I think it was on the slide that we had there was slide 11.
Slide 11? Okay.
Yeah, if we could bring that one up. And so it talks about pension funds. So we took a close look at it and we said, where is the smart money going?
Yeah.
Right? The guys that have the big money, that are getting the investments, that are getting the returns that they want, where is the money going?
Got it on screen there.
That's great. And it would just be the next one, I think.
Oh, next one?
Yeah, that's the one. So what are the investments groups doing out there? So these are some names that you may know of. The Public Service Pension Plan, the Ontario Teachers Pension Plan.
Biggest.
If you look at Yale, Harvard, Stanford Endowment Fund, these are multi-million, in some cases, billion-dollar funds. Huge. And so what are they doing? What does their portfolio look like? And the more we dig into it, and I meet with clients on a daily basis, our advisors meet with clients, and guess what? It doesn't mirror what you're seeing on the screen. It doesn't mirror that. On average, these guys are holding 40% in alternative investments.
Okay, stop right there. So you're saying that some of the biggest funds out there, some of the guys that everyone knows about, and they're making literally millions, if not billions of dollars, they carry alternative investments.
That's right.
40%.
And always
40%.
have. And always have.
Well,
now, when
if the phones don't ring over that, I don't know what's going to do it, but go ahead.
Yeah, and so that's what we're saying, right? I mean, so when we say we're trying to level the playing field, we want to be able to mirror your portfolio. We want to help people be able to invest like these guys do. And frankly, until recently, that's been really tough to do.
Right.
It's been really tough to do because people haven't had the access to alternative investments. Now, through this concept of syndication, which we talked about quickly, just grouping investors together, by putting due diligence layers in it, even the government itself has put new rules and regulations around this alternative investment space to have the Securities Commission, the Ontario Securities Commission, Ontario, oversee this whole process. And so they know that there's a need for this. They know that there's a need for clients to be able to get access to this. And when I say clients, I mean people in general, to be able to do so. And I think that it goes along what I'm trying to teach is again, we're trying to level the playing field, and we're trying to show you how you can get some of the results that these pension funds have. You know, if you look at what the market has done over the last 10 years, if you didn't have to pay any fees, we all have to pay fees, right? Sometimes 1, 2,
taxes,
2%.
man, death and taxes, yeah.
And these fees are charged on there. And if you didn't sell, and if you were in the market, the most successful index, which is the S&P 500, has averaged 4%. 4.3 over the last 10 years.
Wow.
That's without the fees. A lot of people are negative because they sold and then they rebought and then there was fees and course, so they hadn't really made any money.
Got it.
The average alternative investment portfolio of the organizations that we just looked at was about 10.5%.
Wow. That's including fees and everything you just mentioned.
That's a net return of 10.5%.
You spoke of again the alternative market where they can buy in. Is it as easy to, like with a stock? You buy a stock, you can go in, you can go out. Is the alternative market have the same sort of buy and sell trading floor concept?
No. Again, it's I think the best way to think about it is it's the way investing used to be, right? So you saw a development opportunity, and you said, I'm not a developer, but heck, I'd like to invest in this. I think it's a good thing. And the developer's going, I'm a developer, but I need some additional funds to be able to really make this happen.
Right.
Right? It's lending money directly. It's doing like what the banks have always done. Banks lend money to you on your real estate. They're happy to do it because they've got something secured.
Yep.
And you pay your mortgage, for example. Well, it's just being on the other end now. It's like you're the bank. And when we group together as the bank and you lend the money directly. So it's not going to a money manager who's then going to put it in a stock. It's just going straight into that development.
And obviously someone coming in and seeing the different developments, real estate opportunities that are before them, they can pick and choose, say, you know what, I like this development, it's around my corner, or I know the developer, or they happen to know something about the project, like they would in a rental property. I say, right. you invest where you know. Well, it's the same with developments. You have investments or real estate alternative investments that are local developers.
That's right. You know, maybe I could give you an example. So
actually, before, okay. I don't mean to cut you off. We're going to take a quick break because we'll be right back with the whiteboard. We're going to tear apart this alternative investing and show you how to get involved and where the money goes on your money and real estate. We'll be right back.